What's up guys, Florida Mortgage Gal here, and today we're going to be talking about what happens when you go under contract. Let's get started. Alright, so you've been driving around or your realtor has been showing you properties and you finally found one that accepted your offer. Congratulations. So off to the races and we are moving. The first week is definitely going to be the most intense week of when you're under contract. There's a lot that's happening just to kick everything off and to get it all started. So first things first. You're under contract, and one of the first milestones in the contract is going to be the inspection period. Now, depending on how you've written up your contract, that could be for a couple days, it could be for 10 days, 3 days, 7 days, 14 days. Typically, I see people put it for about 7 to 10 days. During that period, that's when you get to inspect the home from top to bottom. You'll hire a professional third-party inspector. They'll come to the house, to the property, and they will give it a full inspection. They'll inspect the roof, the plumbing, the electrical, everything that you ask them to inspect, because you are going to hire them for different reports. So at the basics, they'll go ahead and give you a comprehensive report of the entire property. Then you can always add on what's called a 4-point inspection, wind mitigation inspection, there's termite reports, there's all sorts of other inspections that you can add to the basics. So speak with your lender, your real estate agent, or the best option is to speak with an insurance agent on what actual reports that you need in order to get insurance on the property and to really check it out from top to bottom. Now, we were talking about the first things that need to happen when you go under contract. So the first thing is to schedule the inspector to come out. Now, most of you have a realtor that you are working with, and 9 times out of 10, they will go ahead and head up that conversation for you. They will suggest a couple inspectors that they've worked with in the past that they know do good work, and you can get with them on making sure that that inspector gets out there right away. The reason we are chatting about this as the first step is because I want to make sure that you have the most amount of time to review those inspection reports. And getting that scheduled immediately gives you the most amount of time to be able to review those reports, maybe negotiate some things with the seller, etc. All right, second step, your earnest money deposit. Now, what is an earnest money deposit? Well, it's a clause written into the contract or a event in the contract where you are putting a certain amount of money down. Now, that amount of money is up to you and the seller to negotiate. So you'll put down maybe 1%, maybe 5%, whatever it is of the purchase price down with an escrow agent. What does all of that mean? Let's say that you're buying a home and you're doing the 3% down on it, you have your closing costs, those are probably another 3-4%, and you put down, a $10,000 earnest money deposit on the contract. That money is going to be held by a title agent, and the word escrow, it's just an improper noun, just like you have checkings accounts, savings accounts, you also have escrow accounts, okay? So the escrow account is just a reserve account being held on the side for your closing day. So when you get to your closing day, if you already put that $10,000 down and you have your 3% and let's say your 4%, let's say total, that comes out to $30,000, well, that $10,000 is going to be applied towards that $30,000, thus making it only $20,000 that you have to bring towards closing, okay? Now, some people will write a second escrow deposit into the contract. Typically, that's at the end of the inspection period. So you have your first deposit immediately, and by immediately, it's typically the first 3 days of when you're under contract or 3 business days. So if you go under contract on a Friday, don't stress out that you have to have it in on Sunday or something, but you'll want to make sure that you take care of it on Monday. Anyways, you'll go ahead and send a wire or drop off a check, talk to your real estate agent, they'll let you know what's acceptable to the escrow agent. But anyways, you'll go ahead and submit that money within the first couple days. Then your inspection period happens, you attend the inspection, maybe you don't. Either way, it's important to review the reports, talk to the inspector if you need to, speak with your real estate agent if there are things to negotiate, and then if there's a second earnest money deposit, you'll go ahead and take care of that at the end of the inspection period, whether that's at 7 days, to 10 days, or whatever you wrote into the contract. All right, so let's say you're getting financing on this property. So now you have a financing contingency. In the Florida as-is contract, you'll see a clause in there that'll default to 5 days, if it's not filled in otherwise, to go ahead and make an application for your mortgage. So what that means is in the first 5 days, or whatever you've written into the contract, you will need to go ahead and submit a loan application with the lender that you're choosing. Now, that loan application, it's not binding. If something happens, you can switch lenders later on. It's basically the seller making sure that you, as the buyer, are making the best effort you can to make sure that you're keeping to the timetable of the closing. That loan application will give the lender everything they need to be able to submit the loan to underwriting and get moving on everything. It's a bunch of compliance documents. You are who you say you are. You're not going to be using the house for terrorism, no money laundering. There's a whole slew of things. It's about 60, 70 pages long that you'll sign through. Most of the time you e-sign it, and then the seller can move forward with everything. Obviously, you'll need to submit documents to the lender as well for them to put with the loan application and hand over to underwriting. If you've done a thorough pre-approval lately, they probably already have most of those documents. They might need an updated pay stub or bank statement if it's been a while since they pre-approved you for the loan. If you just did a pre-qualification letter, then they don't have those documents yet, and you'll want to make sure you get those to the lender as soon as possible, so that way it doesn't hold anything up for underwriting. All right, fourth step. So we've already talked about your inspection, making sure that's scheduled, attending it, negotiating, all that fun stuff. Your earnest money deposit, making sure that's taken care of so that way you're keeping to your contract and keeping that contract valid. Third step, your loan application. Fourth step, most of the time it's your appraisal. So once you've gone through the inspection period, it's time to order an appraisal. Now, if you're doing a really quick closing, let's say a 10-day closing, a 14-day closing, something like that, you'll probably go ahead and order the appraisal the first day of being under contract. And there are times where an appraisal is waived. If you're putting more money down, you have a great credit score, there's different things that can affect if a lender gets something called an appraisal waiver. That's something generated by Fannie, Freddie, or depending on the bank, if they're writing their own paper, sometimes they can generate it themselves. But all that being said, the reason why most lenders will go ahead and wait until the inspection period is passed, or at least until you give them the green light from the inspection, is because most appraisals only take about a week and a half to get back. And they don't want to have you spend your money with a third-party individual, the appraiser, until they know that you're going to be moving forward with the property. And that's after you've reviewed everything in the inspection report. You know, if something comes back in the inspection report shocking, let's say there's, a big one that I'll see is there's polybutylene pipes throughout the entire house. Not a deal breaker for everyone, but it can be a very expensive thing to replace, right? You have to rip out all the walls, replace the plumbing, and then, redo the house. That's more of an expense that most people want to take on and an inconvenience as well. If something like that happens, we want to make sure that we're not spending your money on the appraisal. Now, the appraisal is ordered by your lender, so you don't need to make sure that that's happening. The lender is going to make sure that's happening. Now, you can always communicate with them and have conversation about it and make sure that they are on track with everything, but most likely they've got it. That appraisal is going to be a report that's going to look at 3 to 6 homes that have sold in the nearby radius. Typically it's a 1-mile radius in the last 6 months. If there's not a lot of sales that fit that description, they might go back farther or they might make it a larger radius. Anyways, the appraiser will compare those sales to your potential home. So they will lay those homes side by side, and using a comparison method, they will maybe add value. Yours has a pool and that sale didn't. And using a comparison approach, they will add or subtract value to come up with the value of your home. So, if your home has a pool and that home didn't, then they might add a little bit of value to your sale. Once you get that appraisal report back, it should be time to wrap up with underwriting and the rest of your deal. Throughout this time, the loan officer probably has been reaching out to you for a couple e-signatures here and there, a couple explanations and documents or banking, or a copy of your banking since the earnest money deposit check cleared, those kind of things. So little clerical items to make sure that the loan is moving along. But by the time the appraisal gets back, most of those items with underwriting should be done already, and you should be getting pretty close to the closing date. Now, it's great to have that appraisal done ahead of time, so maybe you have that appraisal back by day 14 or 2 weeks into the whole process, and you're closing on a 30-day timeline. That's fine. That's why I say there's a lot more that happens at the beginning than at the end. You should be able to kick up your feet and relax at that point. All right, that's basically it. So a few side notes or a few things worth mentioning in this all. Most contracts have something called a loan commitment period, okay? That loan commitment period is your protection. So if you put down $10,000 earnest money, then you will get your $10,000 back as long as the lender issues a formal denial within that loan commitment period. Now, if you have a 30-day loan commitment period and on day 31, 35, something happens and you can no longer get the loan, that's an issue. Then you will most likely lose that earnest money deposit from the beginning. So it's very important to keep up with the lender as they're asking for items to make sure that you're on track, because the sooner you get all that done, the sooner you get to those glorious 3 words from your lender: clear to close. Clear to close means that the loan is fully done in underwriting, and at that point you really truly can kick up your feet and relax. Now, there are things that can happen after the clear to close that can cause you not to close. So we'll go over that as well. Once you get the clear to close, that means that everything is good the way that it stands. The lender will go ahead and start working on the numbers with the title company to make sure that we can balance and have a full breakdown for you at the time of closing. All right, so things not to do during the whole loan process, and especially from the time that you're clear to close to the time that you actually close. Don't open up any other lines of credit. All right, you can make charges to your credit cards unless the lender tells you otherwise, but do not open up a new car payment, a new credit card payment. Things like that that are going to report as a new trade line to your credit report can mess up your debt to income ratio, and then the lender might not be able to give you the loan as you expected and as everyone expected. So big things to talk to your lender about. If you really need to open up a new trade line, please run it past your lender first, and we can look it over and make sure and see if it's something that would affect the loan or not. If you have a really good debt to income ratio, and by that I mean a lower debt to income ratio, then maybe you can go ahead and fit that payment in and we can just accommodate it in with underwriting. That's it for today's topic. Hope you guys enjoyed. Take care. Bye.